Good afternoon, everyone. Thank you very much for joining. My name is Ian McLeod. I'm your host today. I'd like to extend a very warm welcome to all of our partners and advisors, and most importantly, to the clients, guests, and professional connections who've joined us today. To start things off, I'd like to share a quote from a former US politician. It says, "Tax complexity is itself a kind of tax. And now more than ever, we are faced with greater complexity and ambiguity. And I know many of you are looking for confidence and reassurance in your financial futures. So to help us illuminate how to make the most of your tax year end, I'm delighted to introduce two leading lights of St. James's Place. Nikki Patel, Taxation and Trust Planning Expert, and Claire Trott, Divisional Director of Retirement and Holistic Planning at St. James's Place. So Nikki, Claire, without further ado, it's over to you for the presentations. Thank you.
Thank you, Ian. As Ian said, welcome to everyone for joining us today. So basically, this session is centred around tax year end planning. And what we feel that the tax year end provides is really an opportunity to ensure that your financial plan is in good health. What do I mean by this? Well, essentially ensuring that you are making full use of the allowances, exemptions and reliefs that may be available to you. But also, more importantly, yes, everyone wants to save tax, but it's an opportunity to also ensure that the planning that you've currently got in place is in line to meet your overall objectives, taking your circumstances, of course, into account. So today's session is primarily going to be centred around the main personal taxes. And what we're going to do is talk you through some of the changes that came about of the autumn budget, but then take you through some planning opportunities for you to explore. And it's really important to bear in mind that, these will vary depending on your individual circumstances. Okay, so from an income tax perspective, what did we see? Well, as per the Labour government's manifesto, there were no changes announced in relation to the income tax bands, the rates, so the rates of tax that apply, and the standard income tax allowances. So what this essentially means is that the amount of income that you can earn tax-free, otherwise referred to as your personal allowance, remains at around, well, it's 12,570. This has been unchanged for a while, but there is opportunity to plan around, potential loss of this. So essentially, once your income exceeds 100,000 or more, this personal allowance, which is the basic personal allowance, it is reduced when that income exceeds that amount. And so ultimately, there is, planning opportunity in terms of what you can do in order to reduce that level of income and retain your personal allowance. Now, with a lot of these allowances being frozen, it is really, really vital that you do seek advice in relation to this. And also what we are expecting is that the personal tax thresholds are to be uprated in line with inflation from 2028-29. So that in turn will mean that more individuals will, of course, be able to earn more before they start incurring higher taxes. From April, we will see a slight increase in the blind person's allowance, as well as the married couple's allowance, together with a slight increase in the income limit that applies for married couple's allowance. Remember, every individual benefits from a dividend allowance, and currently that remains at £500. From a general planning perspective, I think it's really important to bear in mind that trying to use these allowances where possible, because I appreciate for some people, it just depends on your circumstances, but investing couples should try to think about using some of these allowances that are available. There are certain restrictions when it comes to the personal savings allowance, and also in terms of how these allowances apply to various sources of income. As I mentioned, the dividend allowance is applicable to everybody, but therefore what a lot of people may be considering is what can they do in terms of maximising income where their dividend income may already be in excess of that £500. So tailoring your portfolio to ensure that you can use some of these allowances can be vital. I've mentioned there that couples have more scope to use allowances. I noticed from the poll that we haven't actually got that many people on the call today that aren't working, but there is something, and just to reiterate, just to remind you, that if you're somebody who doesn't use your full personal allowance, so this is the 12,570, it is possible to transfer 10% of that to your spouse or civil partner, provided they're a basic rate taxpayer. From a tax saving perspective, it's not that much, it's around 250 quid. But if you're doing that over time, obviously that, you know, that would add up. Using things like your annual ISA subscription limit is going to appeal to many because it helps build a tax-free fund, okay, because all growth within there is completely tax-free, and it provides for flexible access. So as and when you need to maybe have access, and you could be a higher additional rate taxpayer, you can use some of the funds saved in the ISA completely tax-free. Remember that with the ISA subscription limit, it currently stands at £20,000. It is an annual limit, so there's no opportunity if you haven't used a previous year's subscription limit to use it. So given that we're at the 6th of February, now's a really good time to think about whether you have maximised that, or if you haven't, you've still got a few weeks to make sure that you get those ISA subscriptions in there. There is also, I haven't mentioned it here, but remember that junior ISAs exist for children. So, you know, some parents might not want the children to have so much, but if they're going away to university or higher education, they will have it at 18. There is the opportunity to save for them as well. In terms of, you know, some other investments, obviously, to benefit from what's referred to as tax relief, and the way in which this works is there are certain investments that you can invest in and obtain income tax relief. What that means is once you've calculated what your liability is, if you invest in certain types of investment, you can actually reduce your income tax liability, okay? You will need to seek advice. These are considered high-risk investments, and primarily those individuals that tend to look to these have already carried out some of those key investment options already. For example, they've already invested in pensions, ISAs, maybe unit trusts, etc. So it tends to come you know, as an alternative or at the end of when they've considered all their other options. Pension contributions and making charitable donations. So where I mentioned that 100,000 limit, there is scope for planning in order to reduce that income limit to really benefit from your personal allowance. And remember that those of you that may be subject to the high income child benefit charge, we've seen an increase in the threshold at which that applies, which is now 60,000. But once income is 80 or more, you would be fully liable to that charge. So again, there are some planning opportunities whereby you can reduce that income in order to not be subject to the charge. So if you're there thinking, you know, maybe that's you, do definitely seek some advice in that regard. I'm now going to pass over to Claire, who's going to take you through the national insurance changes.
Thanks, Nikki. Quickly before you go, there was a question about the married person's allowance, and I know it's been answered online, but do you actually have to be married? Is the quick question for you? You do actually have to be married.
Yeah.
There we go. It might not be worth the whole cost of getting married in order to get that allowance, so as it's quite small. Definitely worth considering. So yeah, we're going to talk about national insurance. National insurance was one of the big headlines of the budget that we saw with that increase to employers' national insurance, an increase of 1.2% from 13.8 to 15. There wasn't an increase to personal, so that is worth noting. But actually, for employers, and I know we have some business owners on here, there's been quite a big uproar about how much change and how much extra cost that's going to bring to our business owners. But there is a reduction in the secondary employers' national insurance threshold, which means that the rate at which they start paying it and the discounts can actually mean that some people who were paying national insurance for their employees will not be paying them going forward as well. So there's some other periphery changes. So as an employer, don't just take the headline there, get some advice and definitely have a look at that. But just looking around some of the planning here for national insurance. So making pension contributions via salary sacrifice. So if you're an individual and you're paying into your workplace pension scheme and your employer gives you the opportunity to reduce your salary accordingly and have that money go in as an employer contribution, it bypasses that national insurance test. There are restrictions around this. So you can't just say, I'm going to put all my salary into my pension and avoid paying national insurance and everything. You can't reduce your salary below the national minimum wage. And you need to make sure that you're ticking all the appropriate boxes. The other thing to bear in mind is it will show on your payslip as well. So if you're using your payslip as evidence of earnings, then it needs to be clearly shown. So if you're trying to get a mortgage and show that sort of thing, then you need to show what you're actually getting there. So it may impact those and may impact other benefits as well. So just be mindful of that salary sacrifice is a really good thing for saving that national insurance, and quite often your employer will pass over some of that saving, but actually it can have a knock-on effect. So again, getting advice, understanding how all that works. We're currently in a situation as well with the national insurance up until April 2025 that certain people can backdate some of their missing years a lot further than they will be. So after April 2025, you're only going to be able to pay missing years for the last 6 years. Whereas up at the moment, there's a much wider scope, depending on your age, and as long as you're below state pension age, then consider whether or not, if you've got gaps, whether or not you can fill those. Having a look at your state pension forecast and understanding where your gaps are is something that you can do with your partner and have that conversation and work out how to do it. But time is running short, and this has been extended a couple of times already. But I suspect there'll still be a number of people who are rushing to do it at the end. And it can take some time because we need to make sure that we're giving them right money into the right accounts to make sure that we're getting the correct national insurance being filled. So there's a few things to consider around national insurance, but it's not been one of the biggest personal changes. It's much more around that employer. But it's always important to make sure that you're covering these bases and you're thinking about them. I'm going to pass back to Nikki now, who's going to talk about capital gains tax.
Thank you, Claire. CGT, well, we've had a lot of changes around capital gains tax. One of the big ones is the CGT exemption. Now, interestingly, capital gains tax is not a huge revenue driver. So things like income tax, national insurance, big revenue drivers. Capital gains tax, not so much. However, what we've actually seen is we have seen a significant reduction in the capital gains tax allowance or exemption, and it's actually gone down from 12,300. It went down to 6,000, and now it currently stands at 3,000. So there's a significant decrease in terms of the allowance available. What we did kind of, or what was actually speculated within what would happen in the autumn budget was there was some speculation around the capital gains tax rates being aligned with the income tax rates. Safe to say that didn't happen. However, we did see some increases, and I think the sting in the tail here was those increases were applicable immediately, i.e. not really leaving much time to plan. So the basic rate went up from 10% to 18%, and the higher rate went up from 20% to 24%. However, it's really important to still bear in mind that whilst these rates have increased, of course, the rate that you're paying on your capital gains is still lower than the rate you'd be paying on your income. So yes, it's gone up, but for your higher rate taxpayers especially, it's still better potentially to be paying 24% as opposed to 40%, 45%. For residential property, these rates are 18% and 24%. And when I say residential property, don't panic. I don't mean the property that you live in and have lived in as your main home. I mean your second homes, other buy-to-let properties, etc. We had some changes in relation to, so if you think of trading businesses and disposing of assets within your trading businesses, before you could release, if you like, about £1 million of gains paying 10% tax. These rates have gone up. Now, there's various conditions that need to be satisfied for this relief to apply. So advice would be key, but what we have seen is that the rates payable have increased, and from April 26, we're going to see a further increase to 18%. And I think, you know, when it comes to planning around this, it's a good time to start exploring what you would maybe be doing when it comes to planning around your business. In terms of general planning, the CGT allowance is very much based on a use it or lose it. And I appreciate a lot of this will depend on what investments you currently own. But if you haven't used your exemption currently, then there is scope to be able to use that. And as I said, it stands at £3,000. Again, with couples, there's something to bear in mind, that it is possible, if you hold a portfolio of shares or unit trust investments, you can actually transfer to spouse or civil partner. And effectively what you're doing is you're passing some of that capital gain onto that person. The kind of thing to be mindful of is, you know, the idea is that it's a complete outright transfer. So they then go and, you know, sell those shares later down the line and use that money for them. But that does provide more scope to use these allowances. Think about losses, really important here. If you yourself may have incurred some capital losses, and I'm talking historically, there is an ability to be able to use it. So I don't want to go too much into the depth of the technical side of it, but you basically do have to claim these losses, and that is really, really important. You've essentially got 4 years from the end of the tax year in which that loss occurred to make a claim with HMRC. Don't panic if you're not currently registered for self-assessment. You can do this by writing to HMRC, but the key here is if you haven't claimed it, you won't be able to use it against future gains. Okay, so think about whether or not you have in the past even disposed of assets where a capital loss has been made. Have you got opportunity to claim that loss? And if you have, then now's the time to act to make sure that that has been claimed. I've mentioned bed and ISA, so this is a neat way to be able to use the exemption. So you can literally sell down some shares, realise a capital gain, hopefully within your annual allowance, and then repurchase within the ISA wrapper. Okay, so that's an opportunity, and the same by transferring to spouse or civil partner. I always say, I don't really like mentioning pensions, yet whenever I'm talking about planning generally when it comes to either income tax or capital gains tax, pension contributions always come into the mix. So making pension contributions effectively has an effect of extending what's known as your basic rate threshold. So you can reduce potentially the CGT rate that you might pay on some gains. So again, there's you know, an opportunity here to really seek some advice if you feel that you have incurred a capital gain and you want to do some planning around that to pay a slightly lower rate. Mentioning business shares and assets and how they should be passed on. So I'll come on to the inheritance tax shortly, but I think it's really important with some of the changes that we have seen, thinking about whether or not, you know, some of the shares within the business, if family members are involved, is there an opportunity to start bringing them on board, transferring some shares? This will have tax implications, but trying to plan around what what the succession of that business looks like, whether it's to claim CGT reliefs or potentially inheritance tax reliefs, as I'll come on to talk about, it's a good time to start thinking about these things.
Nikki, before you go on, we have a
Yep.
question. I think it's a very valid one. What do
Yep.
you mean by bed when you say bed and ISA and bed and spouse? We say it all the
So
time, but I think it needs clarification.
Okay, so basically, so you sell today and you're almost putting them to bed, and then you rebuy in the ISA wrapper. Does that make sense? So you sell the shares today, so you kind of almost like crystallize that gain. So it's just terminology that's just used in interest in the industry, where you've just crystallized that gain. So you've put those shares to bed, but then you've rebought them within the ISA wrapper.
Perfect.
All right. Okay, so inheritance tax. So the current thresholds, and these are effectively the thresholds that apply on assets that you can own before inheritance tax kicks in, have actually been frozen for numerous years. So the nil rate band, otherwise sometimes referred to as the standard nil rate band, has been set at 325,000 since April 2009. And what we've seen is that this is going to be further frozen to the 5th of April 2030. We then had introduction of the residence nil rate band back in 2017, and that initially was increasing, but that is now currently stands at 175,000, and again is going to be frozen till at least 5th of April 2030. So this is 2 years more than what was previously announced. And given that the nil rate band has been frozen since 2009-10, had it increased with inflation, it would slightly be just over £500,000. So there's a significant difference in terms of how, assets that can be passed on free of inheritance tax being payable. So, so we've mentioned the frozen thresholds. Something else that came up of the out of the autumn budget was, and it's not applicable from this April, but it's important to just flag up, is that the relief available for business assets and agricultural assets will be limited to £1 million from April 2026. So you get 100% relief for that, and then it will be 50% on the excess, and also 50% relief for qualifying quoted or unlisted shares, otherwise known as AIM shares, from April 2026 will also benefit from reduced relief of 50%. What this starts questioning with a lot of people is that this new allowance, especially when it comes to business assets and agricultural assets, because this is going to be limited to £1 million, and at the moment, and remember, we are in draft legislation, it's per transferor. So again, when I was talking about business assets earlier, it's really important to start thinking about how you might want to pass on some of these assets, and when that, and how that planning kind of should start to take shape. Claire will go on to talk about pensions shortly, but just to, just for completeness here, remember that it is the government's intention for unused pensions to be subject to inheritance tax, with some exceptions that Claire will cover from April 2027. So what can we do when it comes to planning? Well, actually, there's a lot of planning opportunities when it comes to inheritance tax planning. And what I tend to find is that, interestingly, and these are quick fixes, but not a lot of people necessarily use some of the exemptions that are available to them. Okay, I've listed a couple on the slide here. So there's the ability to yearly give away £3,000. There's the ability to give away small gifts, which is £250, but that can be given to any number of individuals. And there's also the ability to make some gifts from what is deemed to be excess income, okay? And it is vital that that's income, rather than if you'd sold a property and you had some capital and you tried to give that away, different rules would apply there. But there is a lot of scope in terms of using some of these exemptions. And I think from a planning perspective, it's very simple to be able to use these on a regular basis. As I said, they're very They are limited, but over time, if you've been using these exemptions, they can result in significant inheritance tax savings. So getting into the that pattern of gifting is quite vital, and these exemptions are per tax year. So if you haven't used them currently, with your annual exemption, if you haven't used it last year, you could give away right now £6,000 because it stands at 3, but you can't carry it further forward. So it is quite important to think about whether or not you've made use of that. Making gifts in your lifetime, so, you know, the simple kind of, you know, giving cash gifts to another individual. And there is the opportunity where you might think, well, you know, I don't actually want to just give away a lump of money to, say, a son or daughter. I would rather have some kind of control and flexibility. There are trust options available. And the benefit of these is if you set up the trust now, having sought advice, and if it's appropriate for you, you're actually making the gift now. But you don't have to necessarily pass anything to the beneficiary, depending on the type of trust, until way down in the future. So these, you know, it really does provide good opportunity for intergenerational planning, where you might want to be passing assets, you know, down the line, but you can be in control of that and deciding as and when the people that are involved as, you know, included as beneficiaries actually receive some of the money that you've gifted. There's other package solutions. It's really vital to seek advice. For a lot of people, they don't want to make the gift because they feel, well, I'm about to retire. I actually need some, you know, additional income for myself, or I need some access for myself. There are some other opportunities that your advisor can talk you through, where you might either require some regular access or even some flexible access. These are, you know, in terms of what you might want. And so there are some other package solutions which aid in the inheritance tax planning mitigation, you know, that you might want to carry out. I've mentioned here the need for power of attorney. This isn't tax year end specific at all, but I think it is really important to just mention that, you know, as circumstances change, and, you know, for everyone, we kind of, you're going through that financial plan journey. But having a power of attorney in place is really important when it comes to inheritance tax and estate planning generally, okay? As I mentioned, using these exemptions and things, if you're in the habit of using these things, even when you've got a power of attorney, there's limited scope for that for the attorney to actually do inheritance tax planning. However, if you've put some planning in place, so some regular gifting, the attorney can carry on, you know, can carry on making those gifts on your behalf, because you'd already put that into place prior to the need to use that power of attorney. Ensure that your will is drafted tax efficiently. This is quite an important one. Not only tax efficiently, also remember that you want your will drafted in a way that meets, you know, that your desired beneficiaries are going to inherit. So it's quite interesting, but in the UK still, and you know, you come across research all the time, even though numbers of people having set up a will have increased over the past few years, there's still a widespread reluctance for those to write a will. And even if they have, they may not have reviewed it. So what essentially this means is that the wealth is not necessarily going to be passed on not only to those that you want it to pass to, but it might not be passed on tax efficiently. So as I said, these last two are not necessarily in relation to tax year end, but I think they're still very important when you're just reviewing your financial affairs for the tax year in question. And on that note, I'm going to now pass you back to Claire, who's going to take you through pensions.
Thank you, Nikki. So straight on to pensions. I'll double click there, so you sort of skipped over my title slide. But What I want to do is touch on a change first. So this is about tax year end planning, and this is a change that isn't happening at tax year end. But it is something that if you have large pension funds and large estates, to start considering and having conversations with your partner or advisor about now. And I think it's important to think about now. We've got 2 years until this change happens. So what will happen, or what is planned to happen, and what's been proposed by the government to happen, is that pensions will now fall into the estate for inheritance tax. And as we know, we all save diligently for years into our pensions, so we may have significant pensions, which will then be factored into calculating how much inheritance tax is due. What we don't have at the moment is final legislation on it, so we don't know entirely how it's going to work. But we do know that the driver for this is to get people to consider how they're spending their money in retirement and where it's best to draw it from. And that's something that you can have those conversations and maybe do some cash flow planning with your partner to consider. But what happens is any money, or the plan is, any money that's in your pension, in a pot of a pension, so this doesn't count if you've got a workplace scheme paying you an income, or you've bought an annuity that's paying you an income, that doesn't count because that's actually been used to purchase something. But if you've got a pot of money sat there that's invested, then that will fall into your estate and be tested against your inheritance tax bill, and your pension will possibly have to pay inheritance tax. And what it will do is it use up some of your nil rate bands that Nikki talked about earlier, and possibly use up some of your residence nil rate band as well, because if you're entitled to that, you may not be entitled to it because you may not have a residence, and you may not be passing it down to the appropriate people, or your estate may end up now with the pensions being too big to actually benefit from that residence nil rate band. So it is still all under consultation, but it's something to start considering, especially for the retired people on our call, where you're drawing your money from to make sure that you're leaving the right legacy at the end of the day. So lots of planning to happen there, but we've got a couple of years, one, for them to put the legislation in place so we know exactly how it's going to work, and for you to consider any changes to the structure of how you're taking benefits. And again, a lot of that will feed into some of the things Nikki's talked about. So the inheritance tax for one, income tax, because we pay income tax from certain different products. So you might be taking an income from an ISA, which doesn't pay income tax, but you would, if you're taking an income from a pension, that does pay income tax. And it's that balance and that conversation. And that's where our partners and advisors can really add the value to talk you through all the options and the best way to achieve what you want to achieve. And that might not be to leave money to the kids or the grandkids or the nieces or nephews or the cat's home, but it might be that I want to maximise my income in my lifetime. And all of those things are fine. It's having that right goal and working around these changes in legislation that we need to factor into those conversations that we're having to make sure that we're going to get the right thing done for you. But this is still under consultation. They've only just closed the consultation on the 22nd of Jan. There's going to be some time for the government to ponder over all the complaints that we've made to them about this, and then to consider the way to formulate how this is going to work. So it's a moving feast, and we are looking at that. So that's more of a heads up for 2027, but it's something we can start thinking about. Now, just saying on all of that, this isn't the end of pensions. A lot of people say, is that the end of pensions? I used to save into it for pension, for inheritance tax planning. Well, no, pensions are still a really brilliant way to get tax relief up front. We always say tax deferred is tax saved. So you might be paying tax later on, but you saving that and getting that upfront tax relief can be a real win. And it means that you're growing a bigger starting pot. And we talk about compound interest, and I'm not going to get into that today because it's a very complex thing, but basically the bigger it gets, bigger and grows and grows and grows. It's like layering, and it works really well. We do need to consider, when we're looking at things in the future, where we're going to start drawing money from. As I've said, this is still under consultation, so please don't go making any rash decisions on headlines that you've seen out there. Have a sensible conversation, think about it, plan carefully, and don't make any irreversible decisions, such as gifting all your money away to avoid inheritance tax, when actually you're going to need it to live on, because there can be consequences there surrounding deprivation of assets, for example. If you give everything away and you should have kept it, then there can be issues surrounding that. So understand that. And pensions is a long-term plan. So there are still scope for changes in the future, as we've seen over the years. I've been working in pensions for nearly 25 years now, and I think I've been through 3 or 4 significant changes there. And I talk significant, not just the little tweaks around the edges. So things do change. So making rash decisions and irreversible decisions can be something that we don't want to do without real thought through about all those options. So on to the more general things that we're talking about pensions at the end of the tax year. And we've had a couple of questions in already from Andrew and Chris who want me to sort of talk a little bit more about how making contributions can reduce your adjusted net income. So we'll get down to that on the personal allowance, but I'm going to start with the annual allowance and carry forward. And Richard's asked a question in there where he said, in order to use carry forward, and so I'll explain carry forward a little bit, carry forward is basically you've got this allowance, which is our annual allowance, which is as a standard £60,000 that you can put into a pension in any one tax year. And if you don't use previous 3 tax years, you could do it all in the current tax year. So you can bring those 3 unused forward to the current tax year. So you've got 4 allowances to use, say, today, if you've done nothing in the last 4 years. Richard's question was, do I need to actually have made contributions in those tax years in order to carry that forward? No, you don't. What you do need to have done is have a pension scheme. You have to have a pension scheme in existence somewhere, and it has to be a registered pension scheme, so a proper pension scheme, not something I'm saving by putting it down the back of my sofa and I'll get it later. That's not a pension, but an actual registered pension scheme. If you have one in your name somewhere, then you can use carry forward. Carry forward's great. However, you cannot actually pay money in personally to a pension unless you and get tax relief unless you've got earnings to support it. So you can't get more tax relief generally than your amount that you are earning. And earning is an important point. That doesn't include things like rental income. It doesn't include dividends, things that you will pay income tax on. It's things like self-employed income, employed income that you would be looking at. So do I do something to get this money? And that's the amount that you can use to get your tax relief on your pension. So that's the 2 sides to things. We've got an annual allowance where we can put money in, and if we've not used it, then it's great to utilize that and utilize previous years. But say, for example, it's pretty easy to do this example, I only earn £20,000. I say SJP, not that mean, I do earn more than that. If I only earn £20,000 a year, then I could only put £20,000 into a pension. And if I hadn't done anything the last 3 years, I can't really use that carry forward because I haven't got earnings this year to pay it in. However, if SJP were really generous and they wanted to make a contribution on my behalf, that employer contribution isn't tested against my earnings. It's just tested against the annual allowance. So they could put in all those £60,000 this year if they wanted to. I'm not sure they're going to be that generous, but if they wanted to, they could. So that could work really well, especially for our business owners on the call. If they're wanting to put money in and they've not been taking a salary, for example, or they only take a minimum salary, then you can still make employer contributions to do that. So there's moving parts, getting a good understanding of where you are, what you've done, having that conversation with your partner to understand what are my options, what's the best way to pay this in, it is something that's really important. When talking about all of this, I think Nikki mentioned earlier about child benefit and personal allowance and the fact that all of this is tested against this number called adjusted net income. And adjusted net income is basically your earnings, so all your income you pay income tax on, but your adjusted net income, what you're doing is you're taking off things like gift aid, for example, or if you're taking off pension contributions, and that is the personal ones paid by yourself. And one of the questions that Andrew and Chris had raised was really about how do we work that out? What does it include? How much do I take off? So what we do there is we're looking at everything that's subject to income tax. You can take off your gift aid. I'm not going to get into that today because it's generally fairly minimal for most people. But if we're looking at pension contributions, it depends how it's paid. So if you pay it as you would do to a St James's Place plan, you pay it and we reclaim the tax relief, the 20% tax relief. It's that amount you pay in with that 20%, and that's the amount that you reduce. We call that the gross amount. The extra tax relief that you might claim, because you might be a 40 or 45% taxpayer, is not included in that calculation. If you pay it into your workplace scheme and it comes out before you pay income tax, it's already come out. So the amount you're taxed on is already reduced by your pension contribution, so you don't have to take anything else off, for example. And again, if we're talking about salary sacrifice, then what you're doing is you're reducing your income before you're taxed. So again, you don't need to take it off again to get to your adjusted net income. So you end up with the same result, but it depends where you take it off from. And I should say, if you're using salary sacrifice, or if you're using your workplace scheme, for example, where it comes out before you pay tax, you do not need to reclaim the tax relief using self-assessment or by calling HMRC. You only need to do that if you're doing it through what we call a relief at source scheme, where you pay in an amount and we reclaim the 20%. You only need to reclaim the extra 20 or 25 from the government if that's how you're paying it in. And it is possible, just as a reminder towards the end of the tax year, if you've forgotten to do that, which we often do, if you forgot to claim that extra, you can go back 4 tax years. So you can go back and you can reclaim anything you've forgotten to do. So that's money in your pocket. That'll be a tax rebate. That'd be very nice. What could you do with that? Oh, you could probably make some more pension contributions. So there's lots of options there. So as Nikki mentioned earlier, this personal allowance issue, I've just explained how we work out our adjusted net income. So I think the example, someone said they earn £140,000. So if you were to pay in 32,000, we'd reclaim another 8,000, which would mean your pension contribution would be 40,000, and then that means that your adjusted net income would be 100,000, and you'd get your personal allowance back. So some of that, in essence, would be getting 60% tax relief if you are English or Welsh. You'd be getting slightly more if you were Scottish, because actually the Scottish rates of tax are higher. So actually you'd be paying more tax on your income. So you would actually be reclaiming more tax doing that. So you're getting your 40% tax relief, and then you're getting the extra 20%, which you would have been paying income tax on. You'd be getting it tax free. Sounds very complex, but again, talk it through with your partner and they'll be able to explain to you how all of that works. So now is a good time to start working out what I've done, where I've paid it, how I've paid it, and having those conversations and collating all of that for at least the last 4 years to be able to work out what can I get in to get that extra tax relief now. And consider, 1, should I pay it? And 2, can I pay it? And they're 2 slightly different things, and having those conversations about all those other things that myself and Nikki have talked about today to consider what's the best way to invest, and should I invest, and what's my long-term plans. So again, really, really positive things to talk about with your partner towards the end of the tax year. And I will always urge to think about, start these things at the beginning of the tax year as well, so we're not rushing around at the end of the day to try and get this money in the right place at the right time. So I'm always an advocate for tax year start planning, not always tax year end planning. But we get to this point and it's always good to round everything up. Nikki, can I welcome you back to the screen to talk through the last slide?
Yeah, absolutely. Oh, absolutely. Yeah, so yeah, so as Claire just said, what to think about next. So just think about your current financial plan. Is everything in line to meet your objectives? Remember, objectives change over time depending on other things that may happen, marriage, divorce, etc., children coming along. Really just think about, is everything where you want it to be? And you have still got the opportunity. We're at the 6th of February. We've got the opportunity. Set up a meeting because you have still got some time to plan.
Okay. Thank you, Nikki. Thank you, Claire, for those incredible insights. It's time for the Q&A, but before we go into the Q&A, I just want to sort of take the temperature of the room and ask a question of the audience. And the question, which will be appearing on your screen, is, how do you feel about the future tax environment? So Alexa, if you'd like to share that poll, please. So where do you see the future taxation environment going? Just give you a few moments to make your selections. Okay. Okay, quite a confounding answer. 92% feel the position is going to get worse. And given the news we've been digesting lately, who can blame you? There's been an incredible amount of questions put through, and thank you for those who've done so. I've tried to answer as many as we can going through. Nikki, Claire, I think I'll start with the pre-submitted questions, if I may, and then we'll move through some of the questions in the chat, if that's okay. The first question, I think this is one for you, Nikki, noting there's quite a few retirees on the call. This is a question from Stella saying, if your annual income is less than the personal allowance of 12,570, do you have another 5,000 allowance taking you to 17,570, before you start paying tax. Not sure why I'm doing that, but hope that makes sense.
Yeah, absolutely. I think, as I mentioned, something to bear in mind when it comes to the income tax allowances is how you apply them depend on different sources of income. Okay, so that personal allowance of the 12,570 initially applies to things like your earned income, rental income, if you've got pension income. That 5,000, and you've probably read about this, that 5,000 can apply if your other income is below that amount, but that 5,000 is very specific to savings income only. Okay, so if you've got other income that maybe isn't within that allowance, so it's, I don't know, 10,000 if that's used up, then you've got savings of, let's say, 7,000, then magically you can use the unused personal allowance against a little bit of that savings, and then that 5,000. And then also remember, I did mention it earlier, but you've also got something called a personal savings allowance that also applies to your savings income. So, you know, you could have somebody that may have, as in my example, that 7,000, where they could use 10,000 of the personal allowance with the rest of that savings all being tax-free because of the way in which these allowances apply.
Good. Okay, that's brilliant. Thank you. Nikki, another question, but I think is for you, from Wendy. Wendy asks, can I have multiple people give me £3,000 a year? Wendy, you and I are on the same page. I would also like that. But Nikki, I think that's in relation to IHT gifting exemptions.
Absolutely. And yes, you can. So remember that the inheritance tax gifting allowances apply in terms of the individual making the gift. So I could give Ian 3,000, but then if I chose to give Claire 3,000, that would have different rules because that's over my annual gifting allowance of 3,000. But for the recipient, Claire could give Ian the 3,000 and I could give Ian the 3,000, and that would be absolutely fine.
I like where this call is going. Thank you. Claire, a question for you from Tricia. Tricia asks, can company directors pay into a pension plan if they draw no income from the company?
Absolutely. I mean, the rules regarding employer contributions, and that's what you'd be doing, you basically employ yourself, would be making, you can make contributions that are deemed wholly and exclusively for the purposes of the business, a bit long-winded terminology. And that, if it's deemed that, then they basically come off your profit. So you don't pay corporation tax, you pay it on the net amount after you've taken that out. How do we work that out? Well, it's quite difficult. It's one we always refer back to the accountants, because what they're doing is they're looking at the business and they're working out what you do. Are you providing a value to the business? Are you being able to provide that and evidence that? So I always think about this. It's not just about pension contributions. It's not just about salary, and it's not just about dividends. It's that remuneration package for what I do. If you do nothing in the business, then it'd be very difficult to justify. But if you're the sole director and you're doing everything in the business, then it's very easy to justify. So when we say justify, it's technically justifying it to the local inspector of taxes if they were to look at it. But your accountant will have a very good handle on the things that are allowable basically as a business expense against the business and the earnings and profits that you're making.
Fantastic. Thank you, Claire. I'll have to take one more from the pre-submitted ones before we go into the chat. And this is a non-technical question, a great question from Vicky, asking, what weekly or monthly tasks makes end of tax year a breeze, please? So perhaps to both of you.
I think for me, I'll go from if ever you had one, I've got a favourite tax, and it is IHT. I think, you know, as I said earlier, there's so much scope for using some of these exemptions and allowances, yet many people don't do that. So if you had, you know, if you had grandchildren, even children, where you wanted to make gifts for birthdays, so that £250 I mentioned, you could set up these direct debits to make those payments, and then you're not thinking about it in the rest of the tax year. So it could just, you know, you're automatically done some planning there. In terms of that, same with the annual exemption. You can't combine the two, but your advisor will be able to talk to you about that in more depth. But they're kind of what I like to call quick fixes or quick wins. Limited planning, but it's still something to get in place. And the same with your ISA subscription. So you could set up monthly direct debits to, you know, to maximize use of that 20,000 subscription limit.
I mean, I think mine very much very much the same. It's making sure that you start early in the tax year. You're making those regular contributions. As we have seen that actually regular contributions into ISAs, pensions, you tend to get a better outcome than leaving it all until the last minute or even trying to do it all at the beginning. I've seen a question that's come in about how do I work out how much I can put in my pension if I don't know what my overall earnings are in the year, maybe if I'm self-employed. And again, doing it monthly, looking at what you've got coming in, having those conversations. You don't have to pay a regular set amount to a pension every month, but you could pay a regular amount to a pension, so you know you're staying within your bands to make sure that you're not over contributing or you're not under contributing, and working that out as you go along. There's nothing worse than a big bill at the end of the tax year, either for tax or to squirrel it away into a pension. It's great to get it in there as you go throughout the year. Being employed or self-employed, I think it works just as well.
Brilliant, fantastic. Claire, I'll just pick a question out of the chat, which I think is one for you. It's from Kareem, asking, if you're over the age of 55 and you're no longer working and you've not accessed any of your private pensions, how much could you continue paying into a private pension if you wish to do so?
If you've got absolutely no earned income, and that's when I talk about income that you're doing something for, so you're saying you've retired, you're not actually working, you're not bringing any money in, even if you've got dividends or other investment income coming in, you are still limited to 3,600. So that's including the tax relief, and that's what you can put in each year. So my whole conversation about carry forward becomes slightly irrelevant because you're never going to get anywhere near those limits. But 3,600 you can put in without any earnings at all.
Perfect, thank you. And one final question from the chat, which I think you could both answer, but Nikki, I'll put this to you. It's from Andrew asking, will the pension IHT change apply to a spouse inheriting a pension?
So if the spouse inherits the pension, obviously it would just pass exempt. What it will mean is it will come into their estate, so there might be more scope for planning for them. But if on first death you leave everything to the spouse, that will pass IHT exempt.
I want to caveat that one, if that's okay, just on the side of things. Lots of people think that if you leave it to your spouse in trust, then that is still exempt. It's not, because you are leaving it to a trust. So we have our bypass trust called the LPT and the APT, and you may think that the sole beneficiary of that is your spouse. That doesn't mean that you're leaving it to your spouse. It's still to a discretionary trust. So if you want it solely exempt, it has to go direct to the individual of your spouse.
Fantastic. Okay, thank you both. I'm conscious of time. I did promise we would finish on time. But before we close the webinar, there is an upcoming event I would like to spotlight to the audience. Alexa, if you could share the slide. There we go. Thank you. Obviously, financial well-being goes just beyond savings and investments, and it's really about confidence, security, and creating a future that you can rely on. On this note, it'd be great for those of you who wish to join our Women and Money webinar, which is specifically tailored to women looking at financial strategies to help you achieve that security and tax efficiency. And please do invite family and friends to join the webinar too. Thanks again, Nikki and Claire, and to our audience. I appreciate that you've heard a lot of information today, and I get it, it's a lot to digest, and I'm sure some of you left with more questions than answers. We will direct the questions we've received to your St. James's Place partner and answer as many as we can. But it's important to realise the importance of one-to-one advice for a lot of these things. Last year, St. James's Place published a real-life advice report, which was our largest ever consumer survey. And it found that 84% of those taking regular advice significantly benefited in terms of not just their wealth, but also their emotional and mental health. So the proof is in the pudding, as they say. And if we can make a difference to you, it is important to reach out to your St. James's Place partner or advisor.